Hi everyone, Amy and Carmen here with the continuation on our series on assumptions, and we're going to talk on how much an assumption costs.
Yes,
or what are the associated costs with an assumption, an assumable loan, because they're not the same as a regular loan.
Correct.
Yeah.
So a new first mortgage is going to cost a little bit more than an assumption. On an assumption, we'll talk mostly about VA assumptions. You've got the VA funding fee, which is 0.5%. That is not financed into the loan amount like it is on a new first mortgage. That VA funding fee is waived if you've got a qualifying disability of 10% or more. There's no appraisal fee, but you do have the insurance that you pay up front, just like on a new first mortgage. There will be,
and of course, that's just dependent upon your insurance agent and the quote you get from the insurance company.
Correct, because the insurance does not transfer from the old loan to the new purchaser.
Yep, that makes sense. Yeah.
Credit report fees are about the same, and then on FHA loans, the only difference really is that you still have that private mortgage insurance, but there's no upfront mortgage insurance because it's an existing loan.
And what about loan origination fees?
Loan origination fees. So VA has changed the way that they can collect fees now, and so some of the servicers are calling their fee that they're charging an origination fee. So you'll see it, but it won't be that 1% or 1.5%.
Yeah.
Correct.
Yeah. So the biggest amount of money that somebody is going to expect to pay really comes into what's called the gap.
Correct.
And that gap is the difference between what the loan balance is and the purchase price. Right?
Correct, yes.
You want to talk a little bit more about that?
Sure. So we're seeing it's all over the board. So I've got one right now where the loan amount, so the existing assumption balance and the purchase price are the exact same. So that seller is going to break even. I've seen them as much as $1 million. And so those funds, and I think we want to talk a little bit about where those funds can come from too. But that there's no set amount, so it's not like 5% down, 10%. It's whatever the difference is between the sales price and that remaining loan balance.
Yep, perfect. And how does somebody pay for that gap?
So that gap is typically coming from savings or cash that you have in the bank account.
Maybe money you make on the sale of another house, the
Correct.
equity that you get from that.
Correct. So sale on the house, 401k loans, gift from family member.
Perfect.
And so that's the majority of where we're seeing those funds for closing coming from.
Awesome. And that can make a whole lot of sense if you have $100,000 or $200,000 to put towards that gap. And like she said, it's varies. Sometimes it's zero gap money, and that allows you to secure an existing mortgage with an interest rate at 2.25% as an example. That makes, in a lot of cases, a lot of sense.
Correct.
Yep. Awesome. Well, thanks for tuning in again, and we will see you next time.